All right, so good morning, everybody. First, today is November 2nd and first day of November. And we're going to go through a couple of things. We're going to go through rules, right? And the first rule is this one right here. Rule number one says, in order to do a trade, you're going to have to make sure you've got the correct trigger lines. And you also have to make sure that the triggers are located in the right spot. So we're going to spend a lot of time working on that today. Number two, obviously, has to be respected. You can't trade if you don't have room to a target or you hit a spot where you shouldn't be trading into. And then ultimately, number three is what you guys want, right? Is where am I going to get in? So we're going to go through and we're going to talk about that a lot. And what I've done is I've made a little change to a teaching chart. And, traditionally our charts have an 8.2 fib, a 21.3 fib, a 5.1 fib, and a 14.2 fib on it, which creates a lot of red and blue lines for you guys. And so what I've done is I've done something that's a little bit different just for a teaching chart. And I've plotted only the 14.2 and the 5.1 fibs, period, on both charts. And what I've done two different things. So I want you to see how I did this. And the purpose of this is to simplify the education. When you look at our normal chart template, here, let me just show you. Bear with me here a second. I'm going to load the regular 14.2 Renko July 22nd template, which is the one that you all have when you download our software. And what this chart template will do is it plots fibs and triggers, and you'll see multiple fibs and multiple triggers, and they have a red and blue color. And what they will, short version, what will dictate a color change in a synthetic fib. And when I say synthetic, the ones that are from the existing chart have numbers on them and they have lines that extend out to the right, trend lines basically that extend forever. And the pro trader itself will actually plot a bunch of support and resistance above and below the market. When we are applying fibs from another time frame, we plot them as basically a single hash plot, and they don't extend out to the right, but they do exist. Okay, so if they're on the right edge of your chart, they exist. And if they stop plotting, they don't exist. Okay. So, you'll see them change like this from here to here at 8 o'clock in the morning. That just means that the fib itself moved. Or if we break a fib, right, because the synthetic fibs only plot the most current support and resistance. And what I mean by that is, here, let me delete those. When you're looking at a fib, the 14.2 timeframe fibs also have dots on them. So, and it only has dots on the most current two fibs. If you were to go up to the next Fibonacci resistance area, there's no dots. But there will actually be dots on there when and if you break above the prior resistance. So the dots on the lines themselves are kind of marking current support and resistance. And when we're doing synthetic support and resistance, meaning plotting fibs from another chart, we have to go a little bit further and we have to say, let me put these back on again. And again, this is more mechanics. This is not something that you have to do, but let's say you wanted to plot a different fib, or you wanted different time frames, or you wanted to build your own charts or do your own different things. You're more than welcome to do that. So when we have synthetic fibs, they plot from other time frames, 21.3 chart, 5.1 chart, maybe an 8.2 chart, whatever it is. And they will change colors, but the color change itself is going to be determined by whatever the trigger line setting in the synthetic fibs is. And the way this is used is quite simple. It goes back to, a look that you guys have seen many, many times, which is this look where both small triggers are physically below a blue fib. So in this setting, if I would have used the 14.2 triggers as the synthetic trigger line value, which it isn't, it's 21.3, thinking about changing that, but anyway, you just understand the mechanics. If this was a 14.2 trigger in the setting, these synthetic fibs already would be red because both small triggers are beyond it. Everybody understand that? Now, this setting is actually looking at a 21.3 trigger, which is not pictured on the chart. So again, you have to use your imagination and you have to say, where are we relative to this or that? So what I've done for this lesson, and I think I may do this going forward indefinitely, what I have done is I've made a more simple training chart. And again, think about it as a simplification, if you will, of the training side of it. And then once you have been trained how to read the indicators properly, then you can adjust and do as you wish. So what I've done on the 14.251 chart is as follows. Only the 14.2 and 5.1 Fibonacci areas are plotted on both charts. So there's no 21.3 fibs, there's no 8.2 fibs, there's no 8 range fibs. Literally the only red and blue fibs that you see on a chart are from either the 5.1 or if they're synthetic, they're coming from the 14.2 chart. Everybody okay with that? I have also turned off the synthetic trigger changing of fibs. So it's a what you see over here is what you get over here exactly. There's no thinking about it. There's no reading of anything. It's just if it's red over here, it's red over here. If it goes blue over here, it's blue over here. So there's no imagination involved in this at all. It's what you see is what you get. Everybody okay with that? Now I have gone one step further and I have taken the smaller time frame charts fibs, the 5.1 fibs, and I have superimposed them as a synthetic fib area on our larger chart. Instead of actually plotting it red or blue, which gets a little bit confusing because it's a small fib on a big chart, I've just plotted it as a big, wide yellow line. And the reason for this is simple, because when you are going to start reading through your charts and things of that nature, I'll show you the thought process on where I'm headed with this. When you take that chart and then you take each of the lines as an individual line and nothing more, nothing less, you're going to read your trigger lines and you're going to determine what the direction is and what the location is relative to each line, which is the only thing that we do anyway. This is what we've taught you. This is what you've always learned. And this is my attempt at a simplification of the thought process. So again, we're obviously trying to buy the market when it's going up, and we're trying to sell the market when the trigger lines are going down. And when they get inside of each other, we watch out for, support or resistance or change. The second thought process is this one up at the top, because this one is the one that kind of catches some people by surprise. And I'm talking about up here at the very top. You guys see where I'm drawing up here? When the triggers are really spread out and there's a big distance in between the triggers, this is the time where you have to pay attention sometimes to what's happening, not on just the larger chart, but the smaller chart has a tendency, when the patterns suggest, multiple divergences or 3 divergences or 2 divergences and a pivot stop out, or 3 divergences and a pivot stop out, or red background and a divergence, or red background and a pivot stop out. This is basically every reversal pattern that we have on a single chart. This could end the trend depending on the areas over here. If there's no area, this ends the trend. If there's an area, you usually will get one more. And then if it doesn't follow through again, then it usually will fail. So again, whether or not you do a second or a third trade is dependent a little bit on what the Fibonacci areas are. If there was only Fibonacci resistance up here on the big chart, then the fact that the triggers don't get past it would be a trend ender. You might take one, but you might stop with this. Does that make sense? If there was no Fibonacci area up there at all, and there was all Fibonacci support right here, then you might do one here and you might manage it. And then you might say, you know what, if I get one more, I might do it again. And then you really have to, you have to really make some decisions with this area over here. So it kind of depends on what fib is over in this area. So if it's up here, it's over. And if it's down here, then you have to kind of navigate whether or not you're going to continue doing something. So with that being said, we're going to essentially look at a couple different things. And let me go through this chart with you real quick. This is a super simplified chart, no triggers whatsoever. And yeah, Jerry, don't weight the small chart the same as the big chart. You start off on the big chart and then you look at the little chart. But look, when you guys get your fibs and your software, these are support or resistance lines that are on the chart. The only one that's not exactly horizontal left to right is the mid bands, right? Which is our moving average, and it can be support or resistance depending on whether it's green or magenta or going up or down and whether the trigger's supported or not. So when you look at just a fib by itself, it's an area. And really what we're trying to do is we're trying to define whether that area is going to hold or break. And we're, so blue lines are supports, yellow dots could be support or resistance depending, right? If resistance breaks, it can become support. And if, resistance breaks, it can become support and it can go back the other way. So in a vacuum, we can't really give the support and resistance areas enough meaning. You can look at it and say, it's a pretty good chance of resistance or support holding. One of the other things that we do is we give extra meaning when we add things to a resistance area, such as divergence or especially a second divergence. That gives me more meaning to the same line than when you hit it without any divergence at all. So we're going to do a couple different things here, and we're going to look at, again, horizontal divergence line plus a 1-to-1 plus a second divergence means a lot more. So we're going to add to the support or resistance lines, and what we're going to do is we're going to use our trigger lines, which you guys all love and know, right? And if the triggers are going up, we're going to look for buy signals, and if they're going down really strong, we'll look for sell signals, and if we get to an area, we'll pay attention to what's going on. So my thought process for a simplified teaching of fibs and triggers looks like this. There's only two fibs to contend with. Is everybody okay with that? Literally, there's only two fibs to contend with, 14.2 and 5.1 fibs during this lesson. You can plot more later, and I know some of our templates have more, but that's not what I'm doing for this lesson. Also, what you see over here is what you're going to get over here. So there's no imagination needed. It's if you see it, it's there, and we're going to deal with it. Now, when you look at a line, you're going to ask yourself two questions. And you're going to basically ask yourself the same two questions every time. If you hit a line, price hits a line, you're going to ask yourself whether the triggers are crossed up or down. And then did we get beyond the line with the triggers, or did the triggers, primarily the small triggers to start with, okay, for this lesson, did the small triggers get past the yellow line? And if the answer is no, then we expect that the yellow line in the short term is going to hold. Everybody okay with that thought? Pretty straightforward, right? If the triggers aren't past the line, we say it may hold. So as we go forward, right? So here's an example of, the S&P this morning. Here I have an extra picture. Hang on. And again, I'm just kind of walking you through a process, and I want you to see the process. And it's the same process all the time, always and forever. And there's literally no difference. Once you get the process down, you can't mess it up. That's my contention. Rarely will you ever make a mistake. So you have to look at lines independently. Okay. So if you hit a blue fib, you have to say to yourself, where are the small triggers? If the small triggers aren't past the blue fib, it may hold. Is everybody okay with that thought? So it's this line and that trigger in a vacuum, and that's really the only little thing you need to make your assessment. Now, the second thought process is, which way are they crossed? So while the fib may hold, because the triggers are crossed down, we're not going long. We're not buying at this area. Does that make sense? And, we see, I guess, egregious abuses of this thought process when people, this is a picture from last week. You guys remember this one, right? Somebody bought the market and their rationale was the lines didn't get past the fib. Right? So this concept is going to instantly make you understand what to do, when to do it, and you're never going to mess up. You're going to make a mistake, of course, but you understand what I'm saying. Your read is going to be absolute. And once you remove the ambiguity from your fib and trigger line reading, you'll instantly know what to do. It's just going to pop right out on the chart at you. It's going to be so obvious. So this was a long trade that somebody did Friday. We'll get back to it. Now, when you pass a line, meaning the small triggers are beyond a line, sometimes you get to a second line, right? And you have to start the process over. Which way are the triggers headed, up or down? And are they above or below the line? Everybody okay with that? That's all you have to ask yourself. If they're crossed down, are they above or below that fib? Or could be a 1-to-1, or could be a mid-band, or could be a divergence line. It's all some type of support or resistance. Everybody okay with that? So literally every time you get to one of these lines, you have to read the triggers. And it's going to tell you whether you should or should not be trading that line. And it's really simple. You either break the line with the triggers below the line, or the triggers have to change direction. So if support holds, the triggers have to roll up in order to actually do a buy signal. So the other choice is, if we hit a fib support and the triggers are not below, right? Again, there's no long signal to go long here. It's merely an area that may hold. It may not. We don't care. All we want is the fibs and the triggers to agree at the same time. That's all we want. Every support or resistance line must be interpreted, Mark. Whether you trade it or not is going to be dependent on your read of the triggers. If you plot it, you have to analyze it. And that's why people that plot too many lines on their chart have a hard time extracting a clear, concise meaning of what they should be doing with the lines. Have you ever seen people plot 50 indicators on their screen and they go, I know what to do? It's like, well, how, anyway, that's a whole nother ball of wax. So anyway, all we want is a very simple process. Are the triggers above and below and nothing else? Okay. And we can have some very clear patterns that you guys already know. I don't have to, we don't have to go through this at length. If you're unaware of the patterns in the trading plan or the videos or the spreadsheet, you guys can review the patterns if you're not familiar with the patterns. But the patterns are pretty simple. So look at how this started out. If the triggers are below the line and they're crossed down, we can start thinking that the market may break through that line. Now, the only issue that we have is this one. Meaning if we get two divergences from a fib, it may hold, and that might be a termination condition. So, the idea is if this pattern breaks and this fib really does turn into a red line, then we're going to continue with a short trade. Right? So it's kind of a line in the sand, but the inclination is that we're going to be going to the downside because of the direction and the location of our trigger lines relative to the fib. Are we okay with that? So we're, again, the rules for going short are what? They're really quite simple, aren't they? I think. You guys tell me. The idea is that we want our trigger lines all going down. We don't want to hit support. And then we're going to sell a pullback into some type of resistance with the idea that we're going to make it down to the support after the pullback. And we go through this a lot in the videos. We don't have to do it here, but the determination, excuse me, of the area that we're going to buy is relative to where the fibs and the triggers all come together, right? There's some exceptions to that on the wrong side, but generally you want the price bars above or below your triggers and you're buying a pullback into a window. Same thing for the short side. You want your triggers going down, you want your price bars below the triggers, and you're selling somewhere inside of resistance. So, without going through the rules, you guys can watch the video. Pretty simple. So we get into this situation where we're like, okay, can we sell a blue fib? Not really, but we're inclined to think because of the location relative to the fib on our 14-2 chart that we are going to be going down. Everybody okay with that read? Pretty straightforward, right? Really easy. Now, what that means is, let me blow this up just so we can see it in a bigger sense here. What that means is, quite simply, if we get the line with the triggers down and below, and we do not actually, in fact, have a second divergence, and the triggers are, in fact, actually going down, we will then sell a pullback to resistance if we get it. The triggers have to be in the right direction and they have to be on the correct side. And then ultimately we have to ask ourselves the second question is, do we have enough room to get down to our Fibonacci target or at least reach our financial objective for the trade? And, the final, you guys did this trade already, right? All of you, pretty much. I mean, I saw a bunch of them posted, but you guys already did the trade, right? Jose, this was your trade. And the exact reasons why you were doing the trade. Well, I don't know what happened over here. You didn't post in that picture, but So you did that same trade, and then you obviously moved your target down a little bit on this trade. So it was the right trade. It was the right read. Everything was 100% in line. And then ultimately, here, I'll look at your second half here. We'll give you full credit, Jose. You had your order at the fib, at the target, and then you changed your mind. And you got out after you gave away $125 of your profit. Now watch, Jose, how easy this is going to be. Are you ready? This is what you're supposed to do as you go through and you do it, and you'll see how easy it is. You have to determine at this point in time, where I'll draw in the pink arrows, your expectation of fibs and triggers holding. So how many triggers are below the fib, or even close to going below the fib? 0. And then as you reach this fib, are any of the triggers already below the blue fib? Same fib, of course, but either set of triggers on either chart. So there's no chance or no premonition or no pre-breaking of the triggers and the fibs. You have to take your money. You don't have to, but the expectation is that you're going to at least get a bounce. So there's no reason to give away $125 of your hard-earned profit. And again, look what you put. You put my exit here at support. Should have put it above support. That would have been my daily goal. I mean, the fib was 1/10 of one tick away. You know, the idea is to put your target. Let me show you in the plan, in the video. Again, I think this is self-explanatory. Once you see it and once you understand it, it's pretty easy. Triggers are going up. You're buying a pullback at supports. Place a limit order just before the fib, so you're getting out on the way up instead of waiting for a reaction. That way, you don't even have to think about it. You just get your target filled, you're done, and no matter what happens, you then are free to analyze what's happening next. And when you analyze what's happening next, you ask yourself the question, should you go short again if the fibs hold and the triggers don't break? And the answer is not yet. And again, look, you guys are going to repeat the same thing. When you hit a mid-band that's pink, you're going to ask yourself, where are my triggers located? Which direction are both of them going? And what are the chances of actually getting above that pink line based on what my triggers, mostly small triggers, tell me right now? So when you look at this mid-band, what's the expectation if the triggers aren't going to break above it? The expectation is it'll hold, right? At least temporarily. And when we look at the real world, you know, again, I'll get you back to the real world because it's always a nice thing. Look, here's where it happened in the real world. As we were trading back up into the mid-band, look, that's resistance. And we have to read our triggers. And you guys just said that it's probably going to go back down. So look, you have to go back and you have to start building your belief system on what the support and resistance says and what your trigger lines are telling you. Because once you actually have a belief in a particular outcome, you're going to be able to make the right trade without hesitation. Now, I'm not saying that there was a trade. I'm just saying your interpretation of whether or not the little pink line was going to hold is absolute. And nothing in these trigger lines being this far below gave you the indication that that pink line was going to give way. Much the same way, nothing initially told, you know, granted they were down strong, sure, but Nothing told us this was going to break until it did. And nothing told us this was going to break until it actually did. And then once it did, if you were open and receptive to what it was saying, you were able to get short and potentially stay short. But, even if you took half of it, you made your daily goal or half of your daily goal. And that's really what, reading the fibs and triggers is all about. It's about, and you can go back and you could do this at any point on any support or resistance across the board. Doesn't mean that there's a trade, right? So I don't want you to always think just because you're at a line, there's a trade. Sometimes it's just sit and wait, right? So you can hit a line, but if the triggers are still going up, it doesn't really mean, go short yet. It just means don't go, right? Don't go long anymore, because if you try to go long on a little chart, you're going to lose. That's what we call our termination area, right? And a termination condition can also change, right? So it starts off as support or resistance that may hold, therefore stop trading with the trend. However, when the conditions change, your anticipation is going to change accordingly. And, again, I hate to oversimplify things, but it really is pretty simple. When you're a new user, you have to have your triggers and fibs looking correct. If you don't, you're going to probably lose. Do you hear what I'm saying? First things first, you must have the correct trigger line configuration, either for up or for down. And again, sometimes you're going to trade bigger areas on bigger charts if they present themselves. And once you actually get the right read of your triggers, you're going to free yourself. You're not going to worry as much about the rules as you are the look of your indicators, if that makes sense. And you're going to be able to just see the opportunities when they present themselves. And again, we still have to have anticipation, right? If the triggers get inside of each other, that tells us what? Yes, we can trade, but you have to be more cautious about maybe it coming to an end, right? And again, look, the end kind of looks the same a lot of times. So, again, look, here's today. So, again, I always like to use live experience to look at the same pictures. And you have to go back and you have to study and say, why was it a top? Right? Again, I could show you theory all day long, like when the triggers are inside of each other, it might make a top. Not until you actually see it in the real world does it become the truth, right? And again, I'm not saying it could have gone up or could have gone down. There's other factors that are involved, like the small chart. When the small triggers are in between the large, you have to read the small chart. So if you hit a fib on a big chart or you have a divergence on a little chart, it could go the other way. Which takes me, Jose, not to pick on you, right, in any way, shape, or form. But when I look at your trade, your first one, and again, you didn't share it, so I can't see it, and it's okay. But the question will be, bear with me, Jose. Again, I'm not picking on Jose. Jose did a good job, and I don't, that's not the idea. The question is, Jose, up here on this chart specifically, do I have a bigger version of that? Let me find a bigger version. Way up here, and again, look, I don't want this to sound like I'm picking on Jose here in any way, shape, or form. But I want you guys to know how I'm going to help you. This one right here that you lost an enormous amount of money on, which is obviously mishandled. My question for you is, what happened on the small chart that you ignored? Because the triggers were inside of each other, number one, I think, when they're inside of each other, once you start making down bars, you should be out of this, whatever it was that got you in. The idea of being on the correct side of the trigger lines, either below them for going short or above them for going long. Number one, you had weak triggers, which is a warning. Number two, you're on the wrong side of your triggers, which is less favorable. The idea is when your price bars are physically above the triggers, you're going to get a lot easier trades. I mean, it's very simple. If the bars are above the triggers, you're going to get easier trades. And it goes back to our trading rules too, I think, for the beginners and the newer people. If the price bars are below all the big triggers, then you get an easier short. If the price bars are above all the triggers, then you get easier long trades. And I saved a picture last week. Let me see if I can find it real quick. I think it really illustrated the point of being on the correct side of the triggers. Over here, I'm going through a lot of pictures. I found it. Look, the idea is price bars below your triggers equals your easier shorts. Right? So, this is a 14-2 chart with just a small trigger on it. So for simplification, price bars below down triggers makes for easier shorts. And I'm not saying that you can't still sell on the wrong side, right? But I'm just giving you a quick thought here. If the entry is on the wrong side of your 14-2 triggers, so let's say you took an entry short on the wrong side of your triggers. The general rule and concept is with this, you better, number one, have a great area on every one of your charts to help you, right? Major support or major resistance, number one. And then number two, you have to have a really strong, sustained trend in one direction to trade on the wrong side. And you could still lose, but this is the safer area and way to trade on the wrong side of your triggers. You understand that, Jose? And if you don't have a sustained trend, meaning it's just barely one little trend reversal, it's not quite as good. It's a really good area, but there's no sustained trend. The trend was down. That's why this one failed and this one worked. And again, just to reiterate the concept, price bars physically above your triggers makes for the easiest trade you're going to do. And again, it's not to pick, but you were on the wrong side. Your triggers were weak and there was no support helping you. Whatever the reason you did the trade, you have to also kind of get out of it just as quickly. Again, you allowed yourself to stay in and hope, and this is the recipe for disaster right here. But anyway, I just wanted you to see how easy the visual is. Weak triggers, below the triggers, nothing helping you. Not really the ideal scenario. As as dictated by the market, not me, right? It's just really reading the market and figuring out what the market's saying at any one time. Now, we do have the election tomorrow, so I anticipate, things could get a little volatile and crazy, and that's fine. I'm more interested in the actual lesson itself of, and you can go back at any point on any chart and you can repeat this same lesson over and over and over. So, just picking a random spot at 2 in the morning, right? So we'll start at 2 in the morning and you can pick a random spot and you have to look at your area as an individual spot all by itself. And ask yourself if the triggers are up or down and if they're physically below support. And you could see where we get that rule true over here, maybe where we have resistance and the triggers are down and below. You hit an area and then the triggers are down and below that area. And then ultimately the triggers are down and below the area, and you end up with the correct trades. And then as you start to get too close to support, you no longer have what? You no longer have condition number 2 true. You no longer have enough room to your target to justify risk. Everybody understand that? You won't have enough room if this is truly support to justify any risk. Now watch. Every line is a vacuum. Okay, is its own individual entity. So as you trade back up to a fib, you read your triggers. And initially you're saying, okay, it's strong, it might break. And then you have to read your midband as a individual entity. So what does it say? Well, you have to judge the strength up or down of your triggers, and then you have to judge the individual line. Are the triggers past the pink line? Yes or no? They have to be way past it or you can't trade it. Are they past it? No. So no trading off of the pink line. Now, every line gets judged individually. So you now have this new line right here, right? And again, it would change colors, but just think of it as a line more than anything else. So when you evaluate this one line in a vacuum, read the triggers. What does it say? Are the small triggers above that line? And are the triggers up strong enough to warrant risking going up? And then you have to judge the pink line again, the second time. So where are the triggers located relative to the pink line? Are they above it? If so, and you pull back to support, if the triggers have sufficient strength to the upside and you have room to your next target, now you get a trade. This one might have been a little iffy because you're coming off of an area, not very iffy, but kind of iffy. And then ultimately, look, you've got a fib and triggers are up and room to your target. And you literally repeat this process over and over and over and over. If you hit a red fib or fib areas, where are your triggers located? If your triggers don't break, I mean, they're up, triggers are up, right? So, which brings me to another slide that I put in our video, which I think will save many of you a lot of trouble. It's not about buying the high or the low all the time. It's about getting in after the fib holds and then the triggers roll. Or after a red fib breaks and the triggers are sustained strong up. And, ultimately it's about knowing when to stop at a fib because the triggers didn't get past it. And you're not necessarily trading the fib itself. You're trading either a breakout of that fib or a rolling of the triggers, right? Which there's not very good, but there's a real good spot. So you're breaking fibs with the triggers going up, or fibs holding and then subsequent rolling of the triggers is the key to success when you're brand new. So when you look at a fib, ask yourself the same two questions. Watch, simple. All right. Direction and strength of your triggers. I should say support or resistance. This is pretty universal. Right, so I'll make this a little bigger so you can see as we're going through it. Direction of the triggers is what? Up, 100%. So we're not going short just because we hit a line. What are we waiting for? Roll or break, right? That's what we're waiting for at the line. We're waiting for the triggers to break above it or to roll down. That's it. You can never, you're going to take losing trades all the time. I'm not saying, not all the time, but you can get tricked, right? But the idea of our management plan with divergence and pivot stopouts and weak triggers is to protect you in those situations. So, yes, they're up strong, but we can't go long until the triggers are beyond it. And you guys have seen this 100 times now. Hopefully, it starts making sense. The thought of an area has to be determined whether it's going to hold or break or 50-50, right? Now we're going to introduce the other concept, which is we also have to pay attention to the location of our large triggers relative to the area. So if we have enough momentum, we'll take a chance at maybe trading a breakout if the small chart agrees. But because some are located above and some are located below, we get what's called our 50-50 look. And our 50-50 look is awesome. And you have to have multiple charts in order to use a 50-50 correctly. Let me show you. This is an older picture, but it really illustrates the point. Watch how simple life is going to be. You have a fib and you have a pink line, okay? And I'm talking about over here on the left. Everybody okay with that? At first, you're not going to trade it because you don't know if it's going to break because the triggers are below it. When and only if the triggers get above it, you can start saying to yourself, wait a minute, that's my look. Triggers are up, and physically above it, so I can take a trade if, but this is where the big if comes in. If the small chart has something perfect that meets the rules, you understand what I'm saying? You can't just trade it because the triggers are past it. You have to literally have the rules met, meaning strong triggers, nothing in the way, and then you buy or sell a pullback to an area. So, in general terms, you still have to have the rules met on the small chart for a perfect trade. Or not just perfect, but you understand the thought process, right? Something that meets the rules. And if you don't know the rules, obviously you're going to have a hard time with this. So you have to learn the rules. But let me pull up the trading plan and you'll see basically the rules. If the triggers are all going up and we're going to buy, it looks something like this generally. Triggers past a fib, they're going up, and then we have triggers up, and we're going to buy at support basically during a pullback. This look has to be true even if it's strong up or 50-50. Does that make sense? So when we look at this 50-50, meaning half are above the area, half are below, since they're up, we can go long as they're past. And, this is an old chart, but you get the idea. You have to have a perfect reason to do so on your smaller chart. Is the triggers going up in multiple time frame fibs with nothing in the way a good reason? I think it is. Now, granted, this is when we used an 8-2 chart, but we kind of did away with the 8-2 chart for simplicity. And we've removed a couple lines and we've cleaned up for simplicity. You can see how if you have too many charts and too many lines, it makes you ask too many questions. So that's why I've kind of oversimplified and just taken it down to this. The only thing you need to know about is the strength of the triggers and location relative to the area. And once you literally, that's all you have to do. And once you start seeing it, you're like, okay, if there was a reason on the small chart to go long, it would have been okay. I don't know what happened. It doesn't matter. Do you guys understand this? It doesn't matter what, I mean, if you got a breakout or you got a trade or you got something that agreed, you could do it long. And it's very clear it's because the triggers are above the Fibs. It's not a guarantee of a win, but it's, obviously it would have won. Every time you get back to an area, you have to assess the same thing. So, again, look, in a strong trend up, it becomes pretty obvious, right? If you hit the Fibs, you have to analyze what's going on. And once you learn to read the Fibs and triggers, so where are the triggers located? So first, let's talk about direction and strength. What's the direction of the large triggers? Up or down? Up, right? I mean, you have to think of it, you're getting to it and it looks like this. You're kind of looking at the after read, which is not 100% fair. So when you get to the area, now you have to read your triggers. And you have to build some sort of an anticipation on whether that area is going to hold or not. So looking at the location of your triggers relative to the area and the overall strength of your triggers, you can go into the Fibonacci areas with what? An anticipation of what's going to happen before it happens. Now, you still have to have a trading rule met in order to take a long trade. But once you have the correct anticipation, it doesn't get very difficult. And you literally just repeat process all day long. If you get to a line, you ask yourself the same question. Initially, you're always never going to have the triggers past it, usually. I mean, sometimes the triggers lead, but not by a lot. So initially, you hit a Fib and that's it. So if you were long, that would be a really good spot to get out. Right? I mean, that would have generated, $500 a contract, just saying. And then look, everything is independent. So now the only thing in the world you have to contend with is this line and these triggers. At this moment in time, it becomes okay right? So I think it's pretty easy to see, right? As we break the triggers above, if you have a reason, on a small chart, you can go long. Market flow, small chart, something. But you've quantified it with strong triggers past a line. That's all you need. Where was the trade? I don't know, but you can see obviously we have some stuff going on here. Now, sometimes you get to a Fib and the triggers are going past it, and then it fails. Now, you can't necessarily, you're going to start off with a long trade, but at some point, remember when we talk about this, you guys will, once your triggers come together, you're going to be much more sensitive to small chart trouble, divergences, pivot stopouts, triple divergences. Everybody understand that? Something on the small chart is going to terminate your trend when the triggers come together. And you can't see it on this chart here, so you have to study it on your other chart so you know what it was. And this is especially true when you have a breakout of a Fib. If it remains strong, you keep going. And if you get a breakout and then double divergence, or you guys understand the termination. Let me just revert to the plan really quickly so that way you guys can see it in the plan. In the plan from the education page at the bottom of the third page, there are divergence exit conditions that end the trend most of the time. So if we have a 50-50 breakout, it doesn't take much to have divergence in the trend, right? This trade. If you have divergence on the small chart, if you have a 1-to-1 on the small chart, if you have divergence from a 1-to-1, if you have two divergences, pivot stopouts, when the small triggers are weakening on the 14-2 chart, it doesn't take much for the market to go the other way. And again, this is in one of your study pictures on the spreadsheet, but when I say the spreadsheet, I'm talking about, from page 2 spreadsheet. Anyway, this picture, look, it's the weak triggers, even though they're past the fib, that tell us that when you have something go wrong on the small chart, the trade's probably over. Don't hang on for dear life. Jose, this is kind of what got you. I mean, there were some fibs here, so yes, you were going to do a trade for sure. I mean, you have to do the trade, but you don't have to stay in it forever. Conversely, look, here's the other one. It's a very similar look, but it's a different trigger line read, right? That's not the one. Hang on. There we go. And again, there's a lot of divergence thoughts. You guys can read through those and let me know if you have any questions. Again, this is a much older chart, but still the same idea. When the triggers are outside of one another and very strong and you break out, the same one little divergence has almost no effect to stop the market. And you see this same theme repeated in what we do in the rules all the time, right? With strong triggers and whether you stay in or not. The other rule, watch how intuitive this is going to hopefully become for you when once you finally see it and the light bulb goes off, it's like, wow. Let me show you from the current trend trade video. And again, I want to make sure that we're being specific to the most recent video. When you're reading a 5-1 chart, the rule is if you get divergence from a fib, specifically when the triggers aren't going to break that fib, that's a termination condition. And then, obviously if we break down, we can do shorts. And then once we reach a fib, with very little exception, if we have divergence from that fib on the small chart and you read where your triggers are located, you're going to know immediately when to stop taking a trade. Watch. Let's look at the live market. Tell me if I'm mistaken here. This is crude oil right now, live. Okay. And everybody can go back and say what you should have, could have, would have done. But look, here was a line which was a fib. At this point, the triggers are up and beyond it. So you could, if you had a reason, right? If reason true, right? Rules, maybe that's even better. If rules true on 5-1, trade, right? Buy. Can we agree to that? Just based on the line and the triggers being above the line. So when you go to your 5-1 chart, it's not a question of, anything other than you understand the rules. So when you get the read on the 14-2 chart, and then you see this on your 5-1 chart, does it meet the rules? To try to buy at support to get up to resistance. I think it meets the rules, don't you? And then just as quickly, you have to say to yourself, you have to incorporate this. So you guys tell me without me telling you. If you have any divergence from a fib, especially when the triggers don't break it, stop doing trades in that direction. Do you understand the condition? So when you see it in the real world, I don't have to tell you whether you should stop trading. You're going to intuitively know that when you reach fibs and you have divergence and the triggers aren't past it, it's over. That's it. It's over. And only when triggers are past a red fib and things change colors, you're going to get a trade. I mean, you're going to see it that crystal clear. There's no guesswork. It's either true or false. And if it's ever I don't know, you can say it's false. You shouldn't do a trade. That crystal clear. And you can start looking at your large chart and saying, okay, give me a larger chart read so I can maybe know what's going to happen. Where are your triggers in relationship to the area right now on a 14-2 chart? They're up, but are they above it? No, not at all. So this is absolute 100% stop, which when you incorporate it with a small chart, right? And a similar rule from another thought process, meaning divergence from a fib without triggers past it, and you don't have triggers on your 14-2 pass either, that's a double chart termination condition for the moment. So when we talk about rule number 2, right, which is pretty simple, if you have a spot or a condition that says don't freaking go long anymore whatsoever, you will lose your kid's college fund, it looks just like this. Do both triggers have to be above before taking a trade? No, Greg. What we said was, and what the video says and the rules say, that you must have wide triggers with these small triggers way beyond a fib, giving you this 50-50 look, half above, half below, but they're really wide and they're spread out, and at least 2 of them are below. You got that? So look, I want you to understand when I say wide, I'm talking about this. Spread out from each other, one way or the other, wide open. You can't do a 50-50 really when they get together. It doesn't work as well. When they're both together, you have to have the blue fib change. Because look, this anything can happen is basically dependent on the color of the fib. So watch how that plays in the real world. The triggers are inside of one another, yes? So when you look at this right here, look, they're inside of each other. So the only way that you're going to go long again is if this line turns blue. Stop trading. Now, some people construe don't go long as go short. And again, I'm not saying that there's not opportunities for counter trend trades, but predominantly you're going to be trading with the trend initially. Now, just to go back to the plan, right? So here's kind of the general thought for what we were just looking at. Because sometimes you get, a parabolic market that just keeps on going and it never stops. So the concept is if it's really strong, but the triggers are inside of each other, Greg, this is kind of the, determining factor. Let me blow this up a little bit so you guys can see really easy. And again, there's no such thing as a guarantee, but what you can do is you can kind of skew the thought process. So look, right here, right? it starts off as they're inside and together, and then you kind of get above, but the triggers aren't really strong and all the fibs aren't really blue. And then ultimately, you really get above and you've got really dense blue fibs to work with. Does that make sense? So over here, you could pretty much say, look, that's kind of the line in the sand. And as long as we don't really get below it, but when you read this area as an individual thought process on what should happen. And look, it's really simple. Direction of the triggers above or below the fib. What is it? The trade becomes intuitive. Right? I mean, it's not a guarantee of a win, but that's a pretty good look. And if you guys remember that last picture, like the one that, and again, I'm not trying to pick on anybody for any reason, but when you see people's pictures and you see them trading weak triggers on the wrong side of the triggers and there's no fib there helping, it's kind of like floating out in space hoping for the market to go up, and that's not really very supportive. And what happens is you end up losing a bunch of money. So the general consensus is, if you're going to trade in a strong trend and you're going to be on the wrong side of your trigger lines, make sure you've got some friends here helping you out, because if you don't have any friends, you're going to end up with this is a lot of support. So if you're on the wrong side, you better have a lot of support helping you and a lot of trend helping you. Otherwise, you just relax and wait until everything lines back up. So, I mean, look, that's pretty simple read at the top, right? I mean, granted, the software did it. We didn't really do it, but it looks, it looks good. Hang on. I lost my chart. Where'd it go? Bear with me. I've moved too much stuff around here. There we go. There's our crude. So again, look, it's not mystical or mad. I mean, it's really nice that the Fibs called the top, right? I didn't call it. You just have to read it. I didn't do anything. The software did it, and all you have to do is understand what it's telling you. Now, you guys tell me, look, in a vacuum without anything else, what did the price hit? What are the direction of the triggers? And what are the location of the triggers relative to the area? So we hit a fib, yes. And the triggers aren't going to get below the fib. But in a vacuum, it's not really a buy signal, is it? Yeah, we don't go short if support holds. Right? And this is where a lot of people get in trouble with, look, the idea is we want the triggers going up and support holding. And then if resistance holds, it's basically go long here, stop going long here. If there was a short, which there wasn't, and you hit this, you would stop going short. So look, everything is in a vacuum all by itself. So look, let's assume that we retest this area. What color is the area, red or blue? Red. But by the time we get up here, we're going to have to ask ourselves, what are the triggers doing? And if they're not crossed down, even though it's a red area, we're not really going to go short. The whole premise behind what we do is that the fibs and triggers are in agreement. So we may get to some areas that may cause us to stop going long or stop going short, but it's not necessarily a trade. Does that make sense? A trade only happens when, and again, we'll get back to the live market. Live market doesn't matter if you don't know this stuff because you're just looking at it being confused. If it doesn't look exactly like one of the buyer sell looks with the fibs and triggers agreeing, then you shouldn't be doing it. Period. It doesn't matter what happens. If the fibs and triggers agree, then you can buy. Right? And again, look, the whole concept is I'm not trying to stop you from doing a trade. I want you to do trades at the tops or the bottoms. So if you get a top, let's just say like a weak trigger and 3 divergences, which is one of our top conditions, look, when the fibs and triggers agree with going down on your small chart, take advantage of it. I'm totally cool with that. But the same way you would go short up here when the fibs and triggers agree after 2 termination conditions, because you get to a blue fib and you have a termination condition doesn't necessarily mean you're going to go long if the triggers are too strong. Tops and bottoms against strong triggers usually break. Tops and bottoms with weak triggers usually give a reversal. So again, it's a function of reading the triggers, but it's really, really simple. Don't do top or bottom trades against strong triggers. You have to wait for it to roll. If the triggers are weak and you get a true bottom, then maybe you could take advantage of it. Is that pretty simple? Don't go top or bottom against strong triggers. Wait for it to roll, which is a very common theme in everything that we do, right? If the triggers are weak and you get a top, then maybe it's okay. If the triggers are strong at the bottom, don't go long because it may break. May not, but again, one of them is gambling and one of them is knowing for sure that you have odds in your favor. And look, traders do this all the time. There was another one that somebody posted in earlier on a range bar chart. And it's somebody who's had software for 15 plus 16 years and they know what they're doing. It's not like they don't know what they're doing. And again, I want you to see the difference though. He said, and I quote, bear with me. I'll show you the picture and you'll see what I mean. I call it the difference between hoping and knowing, right? So I just want to blow it up so you guys can see a little clearer. His rationale was good. I mean, there's no wrong, right? He uses much larger charts, and he said that he was going to be buying this area based on a higher time frame chart, which is not wrong. I'm not saying his method is wrong or his thoughts were wrong. I'm just saying as a new user, you won't want to buy when the triggers look like this. Does that make sense? The triggers are going down and down on whatever chart you trade, and it's a bit of a guessing game versus if the large chart says up, which is what he was saying here. As a new user, wait until the trigger lines agree with the same thought on the big chart. And then instead of hoping it goes up, you'll know it's going to go up. Now, he trades a range chart and a range chart, but he still trades fibs and triggers. And he still uses key areas on big charts to determine when he's going to get in assertively on a small chart, which I'm not saying his entry is wrong. I'm just saying as a new user, you don't really want to trade against triggers on any chart. So if your large chart says up, wait till the small chart agrees and you'll end up with a lot better trades. Which, look, that's our trading plan for you guys when you're looking at the plan. If the large chart says it may be a top, that's totally cool. Instead of trying to sell here or here, just wait for the triggers to roll. And we've been using the same concept for 16 years. You guys have seen this picture many times, right? I mean, look, this is from our trading plan in 2004, 2005. So it looks antiquated, but you get the idea. If you hit fib resistance, price hits resistance. You can even read the trigger from 2005. Tell me what the trigger said. Did they get it way beyond the fib? No. And our rule then, as it is now pretty much on the smaller chart, is what? Wait for the triggers to roll, and then you're going to get the right trade. So I've said the same thing in the videos. Still, your task is not to try to trade the top or bottom. That's not the most, the easiest, clearest way to do what Nexgen does. Oh, hang on. Wrong picture. There's the right picture. It's not about getting in at the high or low. It's about taking a piece out of the middle. And ultimately, look, you guys need to make money, period. And the only way you're going to do that is if you simulate and you learn how to read your indicators. You write out your rules, which I've already made the rules. You don't really have to do it, but you have to make them your own. You have to document your trades in class, make sure you're doing the right things, simulate and replay. And ultimately, consistency is what's going to get you paid. Consistency in the way you read your indicators and consistency in the way you apply the rules. I'll go a little further. I sent this email out to everybody, but I'll show it to you anyway, just in case you don't have it for whatever reason. I want to make sure that you guys have this stuff. Bear with me here. Basically, look, this is the link that will get you to all, I mean, I've got pictures, PowerPoints. Everything that I've made a video out of is on here. But I made this little kind of cheat sheet yesterday, which I'm putting a link to it inside of the syllabus. It's basically all of our educational assets. Educational page for watching the videos, an educational syllabus. So when you guys are going through the syllabus, user guides, trading plans, videos for indicator definitions, trigger line reading video for the class, which this is going to end up being another one. Divergences and management, which is in the plan, and another video for it. Trading plan rules, video plan, class, couple of classes on the rules. Downloading and studying the spreadsheet link, right? You guys have all this. Bunch of videos of what people do wrong, 1 to 4 minute videos. Good looks for trade setups, divergence thoughts that you should learn, Fibonacci and trigger line reading things you should learn, when to stop taking trades on your small chart, which you pretty much know that now, don't you? I mean, it's really just about, I mean, you could go back to every old picture I've ever done, but it's pretty much the same thing. If you get to fibs and the triggers are weak and you get divergence, stop doing it. It's always been the same thing. And, look, everybody wants to learn how to become rich and do really, really well trading in 10 minutes or 2 weeks or 10 days. It's not going to happen. It's going to take you, again, I went through and I put together this syllabus for you guys because I really think, I really think once you understand what you're going to be doing first, right? And again, look, the first step is, I think, we're doing it today really is learning fib and trigger line reading patterns for when it's okay to keep going or stop. once you understand that reading just your fibs and triggers, then you can start adding in that thought process for knowing when to stop trading. Right? Like the one rule we just gave you and we saw in crude oil. So look, I'll show you the slide again, and it's painfully obvious. Any divergence from a fib, especially when the triggers don't break, stop taking trades. Now, that doesn't mean forever, just until what? If the fib changes colors. Well, and especially now that you know what you know, the triggers break and the fibs change colors. Otherwise, you're going to subject yourself to a bit of, again, trouble. So, what's the termination conditions? Know when to stop trading. Know what patterns will cause the market. What pattern do we have at the top or bottom? You guys have seen 100 million times. I want to go to the plan. Look, look, in case you want to know where termination conditions are. In the plan, it says the following two pictures. Look, the first two pictures, because these happen every day. Every day. At a top, what's the look that will cause you to lose your money most of the time, or a reversal? We call it a pivot stop out, 2 divergences, 3 divergences. When the triggers are weak, especially at or just past a fib, you have to really pay attention to what's happening on the small chart. Because you'll get something that happens and then they'll try to run up and pretend like they're going to break out, but they won't. And you'll see it all the time. I mean, look, here's a good example of it. They'll try to run up and then you'll get another divergence, and what happens? It looks like a breakout, but it's not. It's a fake breakout, because the second divergence and a pivot stop out will tell you that it's probably going to go back down. Now they're kind of struggling back and forth, but you can see, I mean, and here's the other part. Did the trigger, assuming that this is our Fibonacci area, tell me where the triggers are. I always like to do it in as a solid color, but makes it a lot easier. And I'm not saying you can't try to catch a breakout if the triggers are really strong on the big chart. But the small triggers are below the large triggers, and they're both below the fib area. Now, that doesn't mean you can't still take a breakout. What it means is you have to have incredibly strong triggers to take a breakout. Small triggers really strong up, or remember our 50-50 look? Strong triggers down and really far past. So I want you to judge it for me. Do we have really strong triggers past the fib? When you evaluate the trigger strength right here, what do you see? Because it's above the fib, but is really, really weak. And that's really where the management from the small chart comes in, because if it's above a fib, but it's still red and really, really weak, this is where the divergence on the small chart ruins our day. We've already done this picture once, and you may not remember it, but I'll show it to you again. Remember we talked about this look? Really, really weak triggers inside. Divergence ends any thought process of going long. When you see it in the real world, you're like, oh, that is really weak triggers at red fibs. It's a little above, but it's not so strong that we're going to think breakout. Right? You understand the difference, right? When you're thinking breakout, you're thinking really strong small triggers, really strong big triggers, maybe break. Not really weak, anemic inside of each other triggers. That will cause the divergence on the small chart to basically make the trend go the other way. So when you see this, let's say you said, oh, I'm excited, I'm going to buy a breakout. Well, if you did buy a breakout, which is not really the right trade, but let's just say you did, you'd be out with divergence because the triggers are weak. Does this make sense? It's not just a divergence on a little chart to get you out. It's the combination of divergence, Fibs not changing colors, triggers are really weak on the 14-2 chart. And with all that stuff together, we're not going up. That's the end result. Now, some people would say if you're not going up, go short. Let's just look. You just have to read where your triggers are, strong, up or down, above or below. And then once you start seeing things go wrong on the small chart, you know it's over. Now, was there a short trade that kind of meets the rules? I mean, not really. It's don't go long anymore, but again, you don't always get short rules. What's the second termination condition we have? 3 divergences in a relatively tight area, right? Now, ideally, we would like to go short, but it's probably going to be closer right here. Right? I mean, there's some traders who will take a more assertive short trade, but generally we want double termination conditions on large and small charts, and then we want a subsequent fib and trigger agreement. Watch. When you memorize the plan and all the pictures, you're going to be like, okay, that's this look right here. Double termination condition followed by triggers and fibs agreeing. We were pretty darn close, but not quite. Double termination conditions on both charts. Anticipation down. Find a reason. Pretty easy, right? Now we have to do the same thing in reverse. Look, or live. When you're doing it live, it's really easy. This was your last support line. What do the triggers say? How much strength and where are they located? Down and below? So the question is, can we sell a pullback if our rules are met? The obvious answer is yes, 100%, 1000%. That's our trade. Just need a pullback. It's not 50-50. It's 100% down. It's strong down, pushing into everything on the planet. It's not 50-50 anything. Once the large triggers get here, and you can't see it, but this fib changed colors too. See how it kind of jumped a little bit? So it was support, now it's resistance. So this is red fib. Look, under normal, I have this up as a teaching chart, but this would be red if you had. Look at it under the normal condition here. It's not 50-50 anything. It's 100%. That's the best look on the planet for what we do. Well, it is with this too. Look, if you think in a colorblind situation, that's the whole point of my little training chart here. If you think in a colorblind situation, it's a fib area, read your triggers. It's not necessarily the color of the area, it's the quality of the area. That almost sounded profound, didn't it? Right? I think you could. It's not what color the fib is, it's where the triggers are located and how strong they are. That's the only determining factor. You know, you had a lot of internet problems last week too, Mark. How's your speed? Do you have a good speed going? Anyway, you guys understand this, right? This is pretty easy. Strong triggers down, everything says okay. And again, we terminated at the top, which is really good. We knew there's a pretty good chance we're going down just because of both chart read. Maybe some people take a more assertive entry, market flow signal, or something that helps them out. Once you know it's going to be a top, you can be a little bit more assertive, right? Once you know it's going to be a top. Now, how do you know? I mean, you don't know for sure, but if it's a 97% chance of rain and there's water falling out of the sky, you can pretty much say it's going to rain. Or if you can see a wall of rain headed towards you, you know it's going to rain, right? I mean, you can look at the radar and see the rain is coming. You don't have to wait until it hits you in the head to know it's coming. So it's the same thing here. We pretty much know that it's going to turn. And again, as you get more comfortable with, termination conditions, like, look, this one was not enough to warrant going short. But once you get this termination condition and you get 3 divergences and you have weak triggers and you have fibs, you start layering, you're kind of piling on ideas on why it's going to go down. And you have to get comfortable with those reasons. And this weekend, I tried to, I put myself under a lot of pressure to try to simplify what we do down into 10 minutes. And it can't be done. I mean, pretty much what we did today should get any new trader to the point where they can watch the videos, understand what's going on, and see what they need to learn and how they need to learn. David, you missed the first part of my speech, which said this is a training chart that only has 2 fibs on it. So you're trying to trade and I'm trying to teach. We're doing 2 different things. So this is a teaching chart that only has 14.2 fibs and 5.1 fibs in yellow. And I turned off the synthetic fib color trigger change stuff, so it's a what you see is what you get. What's on the 14.2 is what's on the 5.1 period. You heard? Are you saying that you wanted to try to get the same settings? And look, I like the templates that we're running. I'm not saying to change your templates. But if you did want to tinker around and play and just see for your own, let me make a picture of what I did, just so you can have a picture. I'm not suggesting this is a better way, right? Make sure that that's false. Make sure that that's false. Make sure that that's false. And then once those 3 are false, essentially all I did was make those really bright, and then I turned off the, oh, darn it, I missed the input. Try that again. So what I did, just to revamp real quick, re-say it again, is I just highlighted really bright and big in yellow the 5-1, and you could change colors if you wanted to know if it really changes. I can see when it hops from one price to another that it changed. But make sure that that's false, 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 and then the trigger line is also false. Yeah, I mean, look, ultimately, look, this is the original template. I'm not changing, but look, if you can't read 2 fibs and 2 triggers, how are you going to read 4 fibs and 2 triggers? Do you understand the difference? I mean, you're kind of adding an exponential layer of complication. That's why the lotto numbers, flipping a coin is not hard to pick. It's 50-50, but if you add a third number, you have a 3-ball lotto. What are your chances? Like 999 to 1 or something like that, almost 1,000 to 1. So every line that you add on to your chart has to have a specific reason for the line. Why would you add a 21-3 fib? Why would you add an 8-2 fib? You don't have to. I mean, some people don't trade, they just use a 5-1 14-2. I'm not saying it's wrong. I'm just saying it's different. Once you don't worry about what you don't get and worry about what you do get, you end up with a better trading life. It's not about what you don't get, it's about what you do get. All right, questions real quick so I'll take a pause. Anything that you guys want to go over? And again, look, it's always the same thing. Where are my triggers? How strong are they? What do I expect to happen next? And when you see it, I mean, it's pretty easy, right? I mean, we should pull back up into some type of resistance area, the expectation. And again, look, you can always lose. It's okay if you lose. The only trick is make sure that you at least do the trades, whatever they are, right? So, if you take a pre-trade picture, it's always a really good thing to do, I think. And again, I take an exorbitant amount of pictures. I mean, even this morning, I took the picture of that. Then I took a picture of, just kind of a read going down. Then I took a picture of the fib as it got hit, and I said the trigger. You don't have. This is the thought process. Triggers are down, but it's still above the fib, and then ultimately watching for the low to break, and then after the low breaks, same thing. This is almost identical to what we have in crude oil right now, is it not? We break below, we're selling a pullback. That's pretty much our trade, and then hopefully we get a fill, and ultimately it does what we wanted it to do, which was some semblance of going down and making some money. All right. Questions, comments, concerns. And again, I want you guys to really, look, I'm going to go through a couple of things. Number one, the spreadsheet. In the spreadsheet, there's a lot of information in here, right? How to reload your charts, daily steps and routines. Look, this is probably we've said this a million times, you've seen in the video. Learn the trigger line and Fibonacci rules for when it's okay or not okay to take a trade. It has to be the first and most important thing that you do. You will never, ever, ever become a great next-gen trader if you don't first learn to read your fibs and triggers like a first grade book. Period. 90% of traders lose, and 90% of traders trade before they know what they're doing. It's not a mystery. Think about this. 100% of the traders that follow a winning plan make money. 100% of the traders that don't follow a winning plan lose money. And it really comes down to a belief system, right? If you have a plan that you've proven that won and you believe in it, you're going to execute it. If you don't believe in what's about to happen, you're going to have fear and anxiety and hesitation and, all the nasty things that cause people to lose. So you have to believe what's about to happen, right? You have to look at a chart and look at your lines and believe what's going to happen. It doesn't have to happen, and you have to be willing to lose a little money in case it doesn't. But if you don't have the right expectation, you're going to lose, and you're going to lose consistently, and you're going to lose forever. I honestly believe that we've got the whole secret to the market unlocked. And that when you have strong triggers in the right areas, you got a really good chance. And when you have weak triggers and you have termination conditions, your chances go way down. And it's really important that you learn the looks that will win or lose, number one. And then number two, that you simulate your trades during the day and you post pictures in class. There's 5 million traders who have all said that they thought they did a great trade that was not the right trade. And it wasn't the right trade for what, like, for example, Jose didn't post this trade in earlier. Now, granted, I got him, right? I saw it and we talked about it, but he didn't post it in. And if he thought he was doing a really good trade for whatever reason, being a newer person, we have to really address this right away, because if you continually make that same mistake, thinking that you had a great trade, but it's not really a great trade, then you end up getting very frustrated, thinking you're doing a great trade, but not understanding why it's not. And if you don't participate and get that really fast, really quick, really instantaneous feedback, so you don't, if you do this for 2 weeks, you end up quitting because you're like, God, this Nexgen sucks. It's awful software. But once you understand that it's the wrong thing to do, you can eliminate it or maybe manage it a little better and make the loss a lot smaller. And then, obviously you can see this is the right trade. And why it's the right trade? Because of the triggers and because of the indicators and the expectation of what's going to happen next, which it did. I mean, right? It went down, made a bunch of money. So when you're trading the right expectation and taking a loss, you're going to say, okay, that was the right thing to do and the right expectation. It just didn't win. It's a lot easier pill to swallow than trading the wrong expectation and the wrong trigger line read and the wrong areas and getting wiped out, as so many do, with ignorance, basically, if nothing else. And it's, and again, it's, if you don't get feedback, how do you know? Because there's a lot of subtleties and nuances, and you just have to participate whether you like it or not. And those that participate usually end up making a bunch of money, and those that don't and sit like quiet sheep in the corner end up losing and going away. So you have to choose who you want to be. And I know you have to swallow your pride a little bit, but it's okay. You're not a great trader. You wouldn't have ended up here in the first place. So accept it. Let's work on consistency. Let's work on the same reads, and let's work on getting you to the balance that you want in your trading account. I think we can get you there for sure. So I appreciate, number one, you guys let me go on for a long time. Number two, learn the right reads of your indicators, simulate, post pictures, and then ultimately, look, this part is probably one of the more important steps. You have to retrade what you did wrong. Think about it. You can't just have a memory of losing, right? There's muscle memory and there's emotional memory. And, what's going to happen tomorrow is not always the same as today, but one thing is guaranteed. If you do the wrong thing today, you're probably going to do the wrong thing tomorrow unless you fix it. And just like football teams go back after the game and they watch film and they say, hey, you were supposed to be over here and you went that way. And that's why they got a touchdown. So the next time they do this, you're supposed to do that. And take a picture of it, watch the film on it, go back and do replay of it. And what happens is you build this memory of success versus a memory of failure. Right? So like Jose, I don't mean to pick on Jose, but he's been here long enough. He's tough. Go back and do replay on this, and whatever you did wrong, fix it. So you don't have this memory. And you replace this memory with either not doing the trade because it wasn't right, or maybe doing the trade and managing it properly so as a small win or small loss, and then you don't have this in your brain. You have the memory of doing it right. And if you don't get the memory of doing it right over and over and over, you're not going to end up making money in the long run. So ultimately, what I would like for you guys to do is to have this spreadsheet and do simulation during the day and, document what you did. And then at the end of the day, go back and do replay and fix your mistakes and make a few pictures, take notes. And then the next day, practice your trades during the day, get feedback in class. And then, if you do the right trade, it's pretty obvious. And it's only going to take you a week or two to say, hey, I got the right trade down if you participate. And then, you don't have to post a million pictures, but the idea is to get you to the point where you know the right trade and you know the wrong trade. And especially if you take a loser, you have to really get feedback on it. Winners are pretty obvious when you're trading with the fibs and with the triggers and everything's going your way. It's not that difficult, right? I mean, a winning trade is not that difficult to see. We know the triggers are right and we know you got in on a pullback and it's okay. It's the losers where you have to really get the feedback, and it's a harder pill to swallow because, if you're getting in at an area, why are you doing it? Why here? Why there? What are you thinking? What are you doing? And this is, one last little step that'll help you become really a lot better trader. Annotation of your chart. Bottom line, you have to write what you were thinking. And this is an old picture, but you get the idea. Write what's happening with your triggers and why you're selling at a particular area, whatever it is. Why did you do it there and not somewhere else? What were the triggers doing and where were they located? And if you write this out on your chart, you very quickly quit making the wrong read. It's almost instantaneous. You can't lie to yourself and say strong triggers down when they're actually going up. It doesn't, you know what I mean? You can't lie to yourself and say they're going up or that you think the market was supposed to be a buy. Because when you go back and look at it, you're like, that's pretty obvious. All right. Let me catch up on a couple of your questions first about what we were talking about. Now, let me ask you a question. I still left this limit order in way up here. If we get to this spot, you guys give me the overall impression based on the triggers, what you think is going to happen at this area. It doesn't have to happen, but what do you think? If you were going to take a chance selling at a fib, is this a good trigger line to do it with? What do you think? Probably so, huh? And again, because it's so strong, sometimes you can break a fib. So, maybe you could make a case for going up to resistance. And then if resistance does in fact hold, which I don't know if it will, I'm willing to take a chance. If it does hold, perhaps we get down to support. So, one of the two areas. Maybe we do, maybe we don't. Time will let us know on this one. All right. I'm just double checking to make sure that there's no questions about the fib and trigger line reading lesson that we've done. Here's the S&P, by the way. They've had a lot of fun since we last left them. And again, I don't think too difficult to see, right? Triggers going down strong. Obviously, it went down. We get a bounce from the mid band. And, again, we got a mess. Kind of got choppy. This is the way I see it. You guys tell me if you see it different. But the triggers were strong enough maybe one time to get a short. And then we hit a fib, and it looks to me like the 50-50 look. What do you think? Triggers were really strong down, but the fib didn't change colors. So this is the area where you have to go back and study what was the management. Does this make sense to you guys when you look at it? The fib never changed from blue to red. So you have to kind of go, okay, what happened in there? Right? And I don't know. I'll have to go back and look at it. But was there a trade? Did you have to manage it? And we could go back and look at it. Look, 9:45. I don't know what happened. We'll find out. We were watching crude, so. All right. So this is where life comes in. And again, what happened before a 50-50? Once you start putting this together, you're like, man, it's so easy. Watch. Can we agree there was a 50-50 look over here? Right? Strong triggers down, but a blue fib still. And then before it got back to a sell area, what did we have in front of it? Double divergence pivot stop out. So we had a termination condition, not managed. We weren't in. So in this case, we actually had a termination condition before the entry. You see that? Two divergences with a pivot stop out says no more 50-50. And if you do it, you end up losing. So condition, no short. Probably a good thing, huh? Looking at it historically anyway, right? And look, you can do the same thing. I know it might get a little wild today or tomorrow, maybe even for a couple of days with the whole thing. But look, if the fib holds with a termination condition and the triggers are really strong, at some point, can you go long right there? I mean, obviously, we can't see the small chart. So we're looking at triggers and conditions coming from areas. What do you think? Okay, let me ask you a question. Absent of areas, should you look for, if you have fib support that holds, absent of strong areas of resistance should you look for a long trade? You guys tell me. I mean, I know the rules. Hopefully you can see. If the fibs hold and the triggers roll, the answer may be yes. And again, look, we have to look and see what happens. But, once we kind of get to the top and we get a weaker trigger and it rolls over, what happens? Was there, the question was, after the triggers roll, was there a reason for a short here? Because when they hold or roll, hold and roll or hold and roll, whatever, was there a reason? Well, we have to go back and look. Let's say you didn't get long here where we drew that fortuitous circle. Let's say you waited just a little bit. Was there any reason to go long here? So this was where maybe you should have gone. Now let's take it a little further. Give me your anticipation of this red fib based on these triggers, strength and location. Is this red fib really good, or is it maybe we could take a 50-50 long, even on the small chart? Very likely to break is what you want to say. So this is the long trade right here that's hard until you believe what your triggers are telling you about the fib. Does that make sense? Once you believe what the triggers are telling you about the fib, you don't fear the fib, you trade into it and think it's going to break. Anyway, and for some of you, you'll wait for it to break and then you'll either get scared out at divergence, but then when you realize triggers are still really strong and you go back to the original thought we had, right? So look, and you go, oh, that picture, if the triggers are really strong, ignore divergence. And you'll be like, God dang it. So what does this divergence do when the triggers are really strong on both charts? Think about it. When the triggers look like this on the left and then this on the right, what does the divergence do? Absolutely nothing except scare new people. Because they're like, oh, I got in, get out. But then when you read the fibs and triggers, you're like, wait a minute, I shouldn't have been out. But by then, usually, you miss this long down here. Then you jump in, then you jump right back out again because you're scared, and then you miss the move, and you're like, what'd I do wrong? And what you did wrong was you didn't take the time to read your fibs and triggers properly before you started trading. That's what you did wrong. Once you learn how to read your fibs and triggers properly first, the trades will become obvious and intuitive. If you try to trade before you focus on the fibs and triggers, you're going to become confused because you're not going to have enough confidence on what should be happening based on what you're seeing. Does that make sense? Without enough confidence on what's going to happen based on what you're seeing, how can you possibly make the right decision? It's literally impossible because you have to do trades and then you have to do management and then you have to decide whether you stay in or out, or you know what I mean? So this divergence doesn't get you out, it gets you in or keeps you in. When, it's the opposite down here, which seems kind of silly because in a vacuum, that looks like a really good spot. But because of your fib and trigger line reading on your big chart being a 50-50, all of a sudden it's not so good anymore. Does that make sense? It looks pretty on the little chart, but it's the big chart that ruins it, being a 50-50. Anyway. Oh, I heard a fill. Look at that. We got filled. And we have a down bar, so we have a stop. Cool. So our anticipation was that fib area would still hold for us, right? Let's look at it together. So we got a fib, we got a fill. So look, I've got $50 risk to make potentially 400. What do you think about it? It could lose, but that's a pretty damn good look, right? It could lose. You see what I'm saying? So, I'm not saying it's going to win. It could lose. But if you said, John, you have to pick a look that you're willing to lose 50 or $60 on, this is pretty much it every time. Now, it may not be and it may lose, but I'll risk 50 or $60 every time to make 400 or 500. And, if I win half of them or lose half of them, it's not really going to matter. And look, it lost. I'm not embarrassed. That's a great look. I do it 1,000 out of 1,000 times. And all I have to win is, half of them make the 500, 400, and lose $50. And again, this is probably still going to go down. So they may have to take this is where you have to decide. Watch. So if you lose 40 or $50, I mean, theoretically, it should have been less risk. Look, the risk should have been after the down bar above the high. So in at 91, out at 95. Granted, I went a little bit higher than that just so we could talk for a half a second. But so should have lost $40, maybe 50. It was actually 60. That's okay. So look, watch. This is a big problem. Are you ready? I have no idea what you're talking about, Chris. We'll catch up on it later. Send me a picture of whatever your trade was. We'll look at it. So look, analyze this line for me, guys, right now. What's the trigger, direction, location, and strength? Should this line hold still or not? Yes or no? Maybe. It may still hold, right? Based on the triggers and the triggers. Chris, I had that in there for 15, 20 minutes and it came back and got me. I wasn't even watching it. So you're overthinking it. But the idea was over here when we placed that trade that we were going to take a trend trade right there. That's where we placed that trade. And I said that the overall thought process didn't really change, so I was going to leave it alone. What's the analysis of this look right here? I mean, hold on. This is what it looked like before a trade. Yes or no? Well, it's different after, I didn't do any changing, Chris. I think you're over analyzing. because, again, the trade could change after you've done what? Had a couple divergences or had 3 divergences. This may no longer be the right trade. I said I was going to leave it in there. I didn't care, but the right trade, easiest trade would have happened if we got a fill over here. So I left my order in regardless of any other conditions. And eventually it got filled over here. So the question is it the right trade way over here still versus over here? Over here, it was 100% perfect trade. And I said it may still hold, but I never, we were talking about other things. I just left it alone. I was like, oh, it got filled. So here's the question, and you analyze it, Chris, with almost support hit and then 1, 2, 3 higher divergences. Is this still the right trade at the right spot? Eh, neither here nor there. I'm just saying when you put a trade on, you have to be able to defend it in court, right? Over here, I would have said perfect trade. As time marched on, which I didn't really pay attention to, it became less perfect, right? And whenever you look, I'm on simulator, so it doesn't matter. Whenever you place a trade, you're going to have to say why you did what you did. And you're going to have to go back and analyze what you did, where you did it, why you did it. So, is it the right trade to go short here? Maybe it is, maybe it isn't. It's definitely the wrong stop. I should have had my stop right above that. Even if I said it's still the right trade. So, this is what a lot of people will do. Look, now is this the right trade? Because a lot of people get pissed off and it didn't go down, so they'll do it again. And what I was going to tell you is, and again, I don't mind losing. It's okay. It's on sim. No big deal. I did have one other winner in there too. So that loss just took a little bit of my profit. But anyway, it's on sim so we can teach. So visually, you see the change though, right? And look, ideally, sorry, this is a little dramatic. Let me clean that up. Ideally, this is what you want pre-trade, right? Per the video, down triggers, nothing in the way. Then you're going to place a limit order at the spot or just below the spot where you're trying to sell, assuming that you actually go up and get a fill relatively quickly without changing the conditions, right? You're going to be filled at that spot and then hope for the best. Now, I did not do this, so I have to take full responsibility for it, even though it's on simulator. That was a perfect trade spot, and I had to say maybe over here I could have waited for a better condition. Anyway, it was a pretty good condition on the big chart, but it wasn't really a good condition on the little chart, was it? So, being on the wrong side of my triggers and not having fibs and triggers together is kind of a guess versus over here, a good trade. Now, let's just say hypotheticals, okay? Because again, you guys have to do this when you're trading. Let's just say, for grins and giggles, that the market just hates our guts and it went up a little bit higher than we wish it would have. Whatever. So ultimately, let's just say that this area is going to hold eventually, right? And eventually the small chart will line up with our anticipation. So watch. Large chart still anticipated to hold. Maybe. If the small chart gets back in line for a short, it's okay for now. Does that make sense, Chris? So I'm taking the big thought from the big chart. And again, it could change. I don't know. But for now, the large chart area is not going to give way because the triggers don't suggest it. So they're doing the old, running up a little higher, but they're still going down trick. Maybe. I mean, look, if these triggers get above that line, then that party's over. So I don't know what's going to happen. But I know that this is my line in the sand and that these are my triggers. And if they're not above the line in the sand, we're going to go down. They can do anything, Chris. Right? But you have to first have an anticipation of what they might do based on the big chart. Do you understand this first portion of it first? This area, even though it overruns a little bit, may still hold because we're looking at the triggers in the area. Are you okay with that? Is everybody okay with that? Because look, when you guys look up in about 5 minutes and it's down here, you're going to go, how did you know? It doesn't have to, but maybe it will. So if the anticipation is still potential down, that's totally cool. Now I need to have a reason on my little chart to get in line with that anticipation. Or else you can anticipate all day long as you want, but you're still not going to make any money. What trade would I use to go short right here? Is there anything in our arsenal that says so? I mean, I guess technically I could have got short right there. Right? That was pretty much where the rules were met, that little white circle. It's kind of close, but since they were strong down, maybe one more, and then the second divergence probably killed the thought. Any reason to go short? Now, you'd be ready for a short, right? Now, give me your next read on this fib and these triggers. So the large chart says it could still go down. What does this fib say with these triggers? No, Jeff, for the love of God. What color is that fib? Red or blue? Okay. Where is the location of the triggers, above or below? So it's a red fib with triggers below it. I'm going to have you rewatch today's video, but the anticipation is we're not going up yet. And you don't build your anticipation from the little chart anyway. This is still the same area. Read your fibs and triggers with the green box as the area. It's going down. It's not going down. It's actually going up, but the anticipation is the area may hold. May hold and is going to hold for sure, two different things. may hold and I have the rules met for a trade are two different things. Yeah, it's a whole bunch of guessing. How about when the rules are true for a short, if nothing changes, you can do a short. Then you don't have to guess. What do you think? If the rules are true for a short, you can do a short. If the anticipation for a short goes away, then if the rules are met for a long, you can do a long. If nothing becomes true, then you can't really do much. Sometimes there's just nothing to do, and that's okay too. All right, bear with me here. What's the direction of the triggers, up or down? Just, I'll make it simple on you now. Down, right? So I'll put on the normal July 22nd template. Again, you guys have to eventually get to the point where you can read all of your fibs and triggers. So this is one of those really good ones where, again, like Jose, we were talking about this, right? If you were buying in this area, again, maybe you had some fibs here helping you out, and then maybe you had to manage out of your position. And then after divergence and all the trigger lines roll, you're more likely to go down. And again, we went down. Now, I don't know what trades we had short going from this point forward. But the only trade you could have done based on the trigger lines are short, right? Can we agree to that at least? From that line forward, shorts are nothing. I don't know what was available and, per the rules, but from this point forward, shorts are nothing. And then more confirmation as we start to break the areas of shorts or nothing. And then as we start to break the areas, more confirmation of shorts or nothing starting about right here. Right? Once the triggers start getting below the areas. So it's shorts or nothing, shorts or nothing, shorts or nothing. And then now it's like, this is where you have to go to your small chart and say what's going on. So let's take a look at short rules and see if we got anything. See if anything sticks out to us. I mean, if you're thinking about a termination condition and a failure of a market going up, is this not like the prototypical look of the party's over? You guys have seen that before, right? That's not a mystery to you, is it? I mean, that's the exact same look of the end of a trend in our video. The end of a trend looks about like this almost all the time. Trend ender and then a pivot stop out, really, with the triggers going down. That looks very familiar, huh? Divergence with a red background and a pivot stop out with the triggers down, and sure enough. And then easy to see we're going down. Now, hard to trade, right? A few divergences. It's like pivot stop out at a 1-to-1 almost, but not quite. And then look, really hard to go short with this look. Hard to go short, hard to go short. Still kind of hard to go short. And then ultimately, once we break below, and it's just a mess now. You can see the thought, which is you still want to go short, but it's kind of short-lived. You get a little divergence. Yeah, well, look, if you got short right here, you're going to have to ask yourself a serious question. And if you got short right there, look, I'm cool with it. You have to ask yourself a serious question if you're short. What's the question? Should you remain short after your fibs change colors and everything's green and going up? I mean, sometimes you have to take what we would term a graceful exit. You got in, but you got back out, right? After your conditions changed, or at least minimized. Cool. And it's okay to lose a little bit trying a trade, and if it doesn't work, it happens. Trigger strength, location, and areas. What do we have? Do we want to do another trade long or a trade long? What do you think? Trade long or not trade long based on this chart? So look, the mid band is resistance, yes. And then we have this area. We basically have a straddle. We have some triggers below it, some triggers above it, right? So this is kind of what we call our 50-50 look, right? Some are above, some are below. I'll show you the look again so you can see it in reverse. Some are below, some are above. So it's a 50-50 long or short. Yes? So, well, the tiebreaker, the ultimate tiebreaker is there anything wrong we got to stop? Or if it's a perfect trade, we could take it. So is there anything wrong with your 50-50 now? Because your trade is here, right? At the fibs and the triggers. So you have to look ahead of time. Over here, there was nothing wrong. So if you would have gotten here, it would have been perfect. Now you've got divergence ahead of a 50-50. Right? This is your choice. It didn't quite make it, so it doesn't really matter. Now, watch this. It's going to exponentially get worse for a long trade if we get another divergence or a pivot stop out. You don't trust it? All right. Well, if you don't trust it, it shouldn't be a setup. Right? So, again, look, you have to kind of determine what happened before your trade setup. What happened before your trade setup? What happened before your trade setup? So if you get two divergences and start coming down, is it going to be a better look? Look, we've already addressed this with the crude oil, right? Remember? If you get two or three divergences before you go short, is it the best short you can do? Right? You guys have to assess this for yourself. It's not my trading plan. It's not my money that's being traded. If you get two or three divergences before you go short, do you normally win or lose? maybe you don't know the answer yet, and that's why you have to track your trades. If the answer is if you have 2 or 3 divergences before your trade and you're going short on the wrong side of your triggers and you lose 90% of your trade, stop doing that trade. If you have, where the heck is that other chart? If you have mid bands that may hold, because the triggers aren't passed, and you still have a red fib that makes it 50-50, even though the triggers are strong, you have to kind of ask yourself a question. Look, I would maybe change my mind if we would have hit the mother lode of a bottom with a double divergences on the bottom. It wouldn't be 50-50. It'd be 100% take a long. Did we really satisfy the bottom? I don't think so. Now, it could be the bottom. I'm not saying it can't. I'm just saying this doesn't give me the warm fuzzies like, oh, that was a for sure bottom. A for sure bottom changes this, the dynamic of this over here. And a not a bottom, right? There's no good reason for there to be a bottom. Makes me think that resistance with a couple divergences would be enough to maybe not take the next long trade. Does that make sense? So it's very conditional. What happened before? Where are my triggers? Where are my indicators? So we added in another little layer of complexity, but hopefully not too difficult. For example, let's take a look at our crude oil one more time. This was a pretty darn good top up here. And then this is a pretty good retest. Where are my triggers during this retest, guys? What do you think? Are we about to break through the resistance or not? What do you think? Probably not. So we're kind of like, the top may be good here. So this, because the top is a pretty darn good top, no chance of breaking. Now, again, it may retest it or whatever, but now 50-50s, if we even get one, would be better, right? Now, we're not even close to the right triggers for going short, so forget about it. I'm just saying, because there's a better top, I feel more inclined that we might finish that move off to the downside. We'll see. Because we didn't finish it the first time, a lot of times they run back up and then they go finish the move. Does that make sense? Kind of like unfinished business down here. Didn't have to, but you get the idea. All right, so back to the S&P. Look, 2 divergences from an area on the big chart that pretty much says, hey, enough is enough for the moment. We'll change our mind if it breaks, right? And if the midband breaks, then I'll change my mind. If not, this is enough to make me stop going long. What do you think? And again, look, there's always a chance that it comes down here and goes back up, right? You have to know what those chances are by looking at your large chart. If it's only a 25% chance, should you take it? If it's only if it's a 90% chance, should you take it? So it's really important that you're determining what the chances are based on what did you hit and where are your triggers. What did we hit and where are the triggers? Should we go long or not? Yes or no? Now, here's what's going to happen because you said no, this is going to go up for sure. Just to piss you off and show you how much money you could have made, but if only you would have known better. It doesn't matter. I say no long. No long is my call. How's that? No matter what happens. And the reason why is because I've made my case, right? Now you have to accept that if it actually does go, then you're not going to get pissed off about it. You can't be pissed off about it if it goes anyway, even if you say no. You can, but it really is self-defeating. Because it may go up. I don't know what it's going to do. But I doubt it. We'll see. I don't know. It doesn't move up till you go short. Yeah. Well, look, this is where you're like, yay, I did it anyway because I felt like it might go up. If you did it, you're only risking this much now. If you did it. Now, if you did it, this is where you're going to be in a third divergence jeopardy. You see it? And I'm not saying it's going to go down from here. I'm just saying if you did do the long, now you're in jeopardy. And it doesn't have to go down. Yeah, it's true, Marco. Now, some of our clients will do it and take it, manage it tight. Other of our clients will say, which we don't have here, but they'll say, I'll do it if the large chart, like a 21-3 chart or something, agrees with it. Or they'll take a signal if there's one of our market flow signals there. So it just kind of depends. There's a lot of, there's a lot of ways to skin the cat, but ultimately, look, if you don't take it, it's not going to kill you. Like I said, I put no long as my call, so I said it's going to go up for sure, which is true because Murphy's law is the only true law in trading. If you do something inconsistently, it's guaranteed you'll pick the wrong one every time. As long as you're consistent, you're going to end up doing well. If you're not consistent, you're going to always pick the wrong thing. Yeah, well, I just don't deal with them. Anyway, look, it went up. I don't even feel bad about it. The risks were XYZ, so they were unacceptable to me, and it doesn't mean they won't be to you. You may say it's worth risking 2 points because if it does go, look, the reward is 99 up to 09. Or at least 04, but 09 is the reward, right? Just like I showed you in the other one. It might be worth $60 or $100 to say, if I get it at 10 points, I don't care if I lose 2 because think about this. If you lost 2, what else would you get? Some people don't mind losing the 2, assuming that they're going to get a chance to get back on board the other way. Again, at these kind of do or die spots, I guess that's always a good thing. Would you go up if I said no? Did anybody do it or not do it, and why? If somebody says you didn't do it because of me, I'm going to kick you out of the room. I'm telling you right now, you can't do it because of me or not. It has to be based on what you believe should happen. Now, sometimes you might believe it's going to rain, but it doesn't. It's not the end of the day. The day goes on, whether it rains or not. So, I didn't do it. It's no big deal. All right. Yeah, there wasn't a lot of other really good reasons. I mean, if you subscribe to trading a 21-3 chart, it was very much not supportive of any long trades, right? If you use a 21-3 chart. Now, look what else the 21-3 chart had at the top. Nice little pivot stop out up there. Anyway. Little past the 1-to-1s, but anyway. My wife's not even trading this week. She's like, I'm staying the heck out of the market. She's like, I'm just going to take a few days off. I don't care. I don't care if I make money, if I miss money. It doesn't matter. Yeah, and again, to go a little bit further, I said if there was something good on the market flow to go along there, and there wasn't even that. I mean, that was the market flow spot. It was like really ugly. And I kind of expected it to be a little bit off today and tomorrow, maybe insane, and today a little bit off. So there's 10 points. It looks good in history. And again, we talked about the what's good, what's bad, and why not. So does the election make a difference? Well, Rich, I think this one's everybody's a little polarized. So I think due to the fiscal policy of the different candidates and the differences in fiscal policy / social policy, I think depending on the outcome, it's going to make a considerable difference in what the market does. I mean, ultimately, it doesn't matter once we get past the volatility of, the decision in a day or two, whatever it is. The market always does what the market does, right? We're not trying to predict anything. We're just reading what's happening now and what are we going to do accordingly. So the news really doesn't have a lot of difference as long as there's not overly aggressive volatility. As long as there's not overly aggressive volatility, then we know what to do. Just follow the indicators. The indicators are just a graphical representation of what the market's saying. And since the market's always right, we just have to try to get in line with it. What does the indicator say about the market right here? Yes, it's going up, but what? Well, look at this look right here, and you'll recall this look from our trading plan very clearly. Look, in the trading plan, hang on. This is the look right here. We have multiple fibs, right? And yellow dots. And the idea is not to trade long after that combination holds, especially when the triggers don't get past it. You guys understand this? Yeah, that's exactly right. So this is a termination condition, and when you see it in the real world, look, it looks strong going up into it. And I'm not saying that we can't keep going. For now, this is an absolute stop going long period. It almost always goes down from this look. I know it seems like there's a strong trigger line, but look, that's why we have it as one of our absolute termination conditions. The triggers were strong going into this one too, and look where they ended up. See it? We ended up going down, 25, 20, 30 points. So we have to start to anticipate the same thing unless the market proves us otherwise. A special spot. What do you think? A special spot in the market. Now, let's look on our small chart and see what we have so we can see how they line up. What do you think? That's another one of our termination conditions. Now, what do you think? Yes? What's the condition? You guys got to memorize these things. Just bang, 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 bang. Because when you see 2, 3, 4 of them in a row, or 2 or 3 or 4 of them at the same spot. Here, let me find this silly picture. Come on, picture. What's the condition, guys? No, it's not a 50-50. Read my picture right here. Any divergence from a fib, especially when the triggers aren't going to break, until the fib changes colors, right? So right now, this is where we're at on the real world. Look, multiple fibs with yellow dots and divergence from fibs on the small chart. So we've pretty much got the mother lode of everything resistancy right here at 1050, right? I mean, that's the mother lode of everything that we do in one spot. It's double chart termination conditions, basically. All right, now, can you get short? Or do you have to wait for rules to be met? Can you get short or do you have to wait for rules to be met? What do you think? Wait for the rules? I like it. So look, real quick, just to kind of recap. And I want you guys to have this. I'm putting this link on the little syllabus thing, but I just want you guys to also realize what all of your resources are. You got a lot of resources, of course, but the syllabus and all of the educational assets. I did email this out yesterday too, by the way. The syllabus and then all the educational assets from user guides to the syllabus to the trading plan, education page, videos, live classroom videos, which today, again, we'll have another one, which I'll probably replace this video in here with what we did today because I like what we did today really well. Anyway, there's, it's always the same thing. I've said the same thing forever. It's just different ways of saying the same thing until everybody gets it or it's easier. So again, use these educational assets. There's a ton of them. The biggest, most important thing you can do is participate and post in pictures. And if you have some to put in, now's the time. I'm going to take a quick 2-minute break and I'm going to at least end this video. And I'll be right back to go through anything you guys want to go through. Just got to take a 2-minute break.